Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have with me Vince Caviglia. He is with Equity Group Investors. He is based in the San Diego area and has been investing down in that area for quite some time. How you doing today, Vince?
How you doing?
Good. Yeah, so I've known Vince here for, it's probably 2, 3, it could be 4 years. Time flies.
It's been a roller coaster getting to it.
Yeah, it's a bit of a roller coaster. But yeah, I've definitely sort of had my eye on Vince and have gone down and met with him in person, a couple years ago, and spent quite a bit of time with him. I had a lot of conversations about investing in general. So super excited to have him on today to sort of, share what Vince and I usually talk about with the rest of the world. He has an interesting way of kind of looking at things in terms of he's very analytical, but at the end of the day, he's out there swinging hammers or, telling someone who is, and, he's in his vehicle probably more than most, driving around and making it happen. So he has a really interesting view of, these markets and has got some good experience. So with that being said, Vince, why don't you share with us sort of, your own real estate journey? How did you get into this business? What attracted you to it? And, what kind of led, you from, how you came into it to then making that decision to kind of strike out on your own and run your own investment firm?
Well, it was a family thing. My family's been buying since 1906 in the Bay Area, different types of real estate. And, I went into lending first after college. I knew I wanted to get into this business because of all the education that I got from family. And so I went into lending first. Then I went into commercial brokerage, and I sold office industrial and single tenant net lease. After that, went into private equity, buying really large pools of distressed debts, maybe in $100-200 million pools, all asset types, land, residential, commercial, all that. And then I went into residential development and fix and flip, and I saw the returns there, and that's kind of what drew me to there, is that bringing my kind of an institutional mindset to a mom and pop asset. I thought you could really outperform, and it helped that like Invitation Homes kind of proved the model there, or you see Lennar right now raising $4 billion to do build for rent, that type of stuff. But like we always talk about, it's like where's the risk? I know everybody always talks about their background, and a lot of times when you get into these talks with investors, they want to know, invest in these pedigrees. And if we're swaying it over to the risk, because this is the Real Estate Risk Report, you could have invested in long-term capital management back in the 90s, and those guys had amazing pedigrees. They had 15 PhDs from the top 3 schools. They were options trader. The options trade off something called the Black-Morton Scholes, and they had Merton and Scholes on their board, and they failed in spectacular fashion and had to get bailed out. And so always the pedigrees aren't always the best. There's a guy that I spoke to at Fairway conference, and I think he had his GED or just his high school diploma. And then I watched his sponsor interview, and he has a 98 plus positive, return on his assets. And, I think there's some other, unspoken things there that you can speak to with investors that are where the risk actually lies. And that's actually what I think my positive benefit is for the market. Is I was actually a dyslexic kid when I was young, and I became a highly curious adult. And, if you watch a Kevin O'Leary interview, he talks about how we pair the chaos of art with the discipline of science. And after reading Annie Duke, I kind of put it together that it's actually more of a stochastic way of thinking. And, this all plays into the factor of like risk, where, you can go out and talk to real estate investors and they are always thinking linearly, like, oh, the inventory is at 1 month. And so nothing bad could ever happen. Or you try to project out, and if they don't understand what you're projecting out into the market, they say, nobody has a crystal ball. I think the risk lies in some of these unspoken things. And we can get into that more if you want, or.
Yeah, well, definitely. I mean, that's that's what we're here to do, right? Is to sort of, how should one look at these things, right? Because if it's, if there's a month of inventory and someone thinks that equals, low risk, which I guess just means that they believe that there's not much inventory, so they're not going to be, left holding the bag, should the market turn, right? Is that like as an example? Yeah, I mean, so let's apply that. I mean, I think your point's well taken, right? Like, there's some really, really smart people with, amazing pedigrees, hedge fund traders as an example with, long-term capital management. I mean, and I would argue, like, in a case like them, it was all, I mean, I've listened to many books about those guys, and, they knew nothing about it. It was all based on, movement and, things they saw. They didn't even really understand. They didn't ever even really understand why they did it. In fact, every time they tried to intervene, they ended up screwing it up, right? Because they tried to use their own logic to control it, and then they learned, like, just let the algorithms, do what they do until the algorithms did what they did, and like you said, they literally created, I mean, financial turmoil across the entire globe in the late 90s.
Yeah.
So. But when you get down to real estate, I mean, that's not the beauty of it, though, is that it really is on a transaction by transaction basis. You have a lot more control, correct? I mean, that's kind of the beauty of it, right?
It is. And, if we're going back to long-term capital management, they use calculus to model the market. I actually use fractals. And, a lot of people are, with this linear type thinking, and risk, and you're going off Annie Duke again, like, a lot of people, once they saw COVID happen, they had hindsight bias and they're like, oh, nobody could have predicted that. But if you go over to Leb, who's a student of Mandelbrot, which models the market off of fractals, he's saying that, COVID wasn't a black swan, it was predictable. It fell within a normal statistical outcome of probabilities. And that's basically because, the 10-year treasury, the dollar, the CRV index were all moving in a certain way that showed that there was going to be a sell-off already. And then, you see all these other people having hindsight bias saying that you couldn't predict it. And I even saw this in pitching, like, an investor, like, I feel like my whole thesis is you gotta think different. You gotta go out there. If you have passion for this business, you gotta go out there and think a little bit different, find the information. And if you have passion, you will be seeking that all the time. But anyways, when I was speaking to this investor, he is saying another linear statement that, like, oh, I invest for 10 years and it's always going to go up. And really that's the Fed training us since the 1980s that every time we hit the down that they're going to come in and save us. And now they're going into more experimental policy that's, distorting the residential market by buying MBS and compressing OAS spreads. These type of things are the things that you should be looking at. That same guy also told me at the start of COVID, he lost cash flow for 6 months, and he's not seeing the opportunity cost there. If you lose cash flow for 6 months, you can't buy all the assets when they're cheap and catch that upcycle. Like, I don't do everything perfect. Mm-hmm. I didn't think that the Fed was going to be able to compress OAS spreads that much. So I held out of the COVID upcycle a little too long, but still, like, that was a decision on preservation of capital because I didn't see it. And I still jumped in and caught like 2/3 of the upcycle. But those are the things that you don't want to be perfect. You want to just be more right, and you want to get these things, and continually improving your process. Um, Another, based off of these fractals and watching the market, I can go back to, prior to COVID, I was sitting with a guy in the third quarter of 2019, and he ran a debt fund. And I asked him, I was like, are you leveraging your debt? And he said, yes. And I'm like, the metrics are looking like there's going to be a sell off. You should start deleveraging. And uh, he didn't listen to that, and now that fund's out of the market. And I don't think a lot of people, when you sit down with investors, are thinking in this fashion. You know.
No. Well, I don't think they are, because I don't think that. I mean, hence why we do the show, is that it's about education, right? So when you're ignorant, you're going to default to things you heard other people say that, because you don't have enough information to understand why that would or wouldn't be true. But if you hear multiple people say it, then you start to believe that it must be true, which of course is just flawed logic. And because people, I think you and I've talked about this before. I mean, people they want certainty, right? They don't like chaos. They don't like uncertainty. So we all are wired to do whatever we can in our own minds to create, constants, things that just make us feel comfortable with the world. Because if everything is always chaotic, it's just no way to live. So then you end up adopting things that in beliefs and mental models that are completely flawed. So from your perspective, just let's explain how this worked out in reality, right? So first of all, what is a fractal? Let's dig into that and unpack what is a fractal. How do you get the information to, just cookies on the bottom shelf, this thing? Like, what does that mean?
It's fractal geometry, and Mandelbrot, he wrote a book that if people want to go out and read, it's called Misbehavior of Markets. I actually, was seeking this information. So I have, quantitatives, as they call them, like mathematician type guys that model the markets. And, if you want to put it into like today's perspective, it's basically a form of chaos math. And instead of having like one point, a linear point like calculus, you're having like a 30-factor model like I have, that when the durable goods order comes out, or the ISM print comes out and is blowing out to the upside, you can put this into your model and see that the inflation's coming. And then you can actually, like, when you start sticking all these things in there, you can see kind of what's going to happen. And they call it like a Bayesian inference, like instead of saying, nobody has a crystal ball, and not even trying to be a little bit more right than the rest of the pack, you're trying to say, there's a 70% probability we're going to get a greater inflation number than everybody thinks. And then you can actually watch like the Fed and Jerome Powell come out and say, the inflation is going to be transitory. And yeah, it's going to be transitory because if you have, say, like a 1.7 10-year right now, in the last CPI inflation print is showing that if you model it out, it's going to be 2.6. That's a negative real rate. So the rates are going to go up. But we just loaded so much debt on top of real estate by them buying down the MBS market that we're already with the low rates, we're getting a higher payment on the real estate. So it's going to take a lesser of a rate move for us to feel it in the market, but everybody's just focused on that inventory number. You know what I mean? So, and it's not like, the other thing that people do is they think that it's like an on-off switch. It's going to crash and go down by 30%. Well, one of my favorite guys, this guy Keith McCullough, always says, risk happens slowly, then all at once. So you're going to watch these metrics like this, the inflation come out and the rates start to rise, and there'll be like a slowing in the market, and maybe the inventory starts to change a little bit. And you can watch it slow, and then it'll happen all at once. But right now we're just at like the peaking period, and maybe, third, fourth quarter, it slows a little bit, and then we get the all at once risk later. So instead of what I'm I guess the way to explain it, instead of linearly, you're watching it kind of like slow and then drop a little bit. And you're doing it by
Yeah.
having, 30 factors instead of one, just inventory. And that's, I
Yeah.
guess, the way to distill it down does that make sense?
Yeah. No, I mean it makes sense, and it means that one, it's fluid. Two, you can't just use a single metric to make your decisions whether to buy or sell, or it's you need to understand all of these other factors and be monitoring them. I mean, and that's what you've done. It sounds like you guys have built those things so that you can make those observations, and then that drives your behavior as a participant in the given market.
Absolutely.
So there's certain times when you're watching it. So like, what's it telling you right now? To buy like crazy, or it's telling you to hold off? What is it telling you?
This I love your podcast has been amazing, and I love the guests that you've had on it. And there's like context that you can add. And you and I have talked about this a bunch. Like you're always changing where you sit, so you can buy. So like, and if let's go back into historical maybe a little bit and then bring it back to today. Like in 2018, you're about to hit something called the one factor model, which we're probably going to hit, third or fourth quarter, which will cause the slowing. And back then I was buying an asset type that didn't really have that much interest rate risk. People buy it with cash. It's low price and they're usually a move down buyer. And so that's what I was buying. I don't think that's going to be what I buy today. It actually isn't. Then, like right before COVID, I was buying ADUs and developing ADUs on property because I thought that was the best thing to buy. But right after that, they were shutting down all the permits and things, and there become entitlement risk, and that's something that I heard you guys talk about before. And with the entitlement risk, this is an interesting thing that happened right now that you can use these models for and kind of watch it as it comes out. One, your entitlement time frame is a lot longer. And then the other thing is when the Fed and the Treasury are buying everything and putting money right into the hands of the people, that there's going to be inflation and the dollar is going to be devalued. And so my asset manager, she actually currently, she's working for a bunch of other investors, and she was telling me all these guys were buying like a whole bunch of ADUs right now. I'm like, it's the wrong time, and they're going ground up. And I was like, they should convert space instead of going ground up because lumber is going to go way high because the dollar is devalued and has a negative correlation to the dollar. And so fast forward 6 months later, they've been holding their entitlements for like 12 months where it should be like a 4 to 6 month entitlement. And now they don't want to go ground up anymore and they want to convert space. And her and I were kind of laughing a little bit, but if you're modeling it, you can see that lumber price is coming, and then you can go over to home builders and see that they have 30,000 more per unit and they don't want it to develop anymore. You know what I mean? So like at one point I was buying something that was all cash. At one point I was buying the ADUs because I figured I could hedge and then rent out the property if something bad like COVID happened, and I was able to get out of those without any problems. And I think something that's going to be coming up really strong in the coming markets is going to be change of use. And I've talked with some other, larger funds that have been doing it on like single tenant and changing it into like, apartments or self-storage or things like that. And I asked them, I was like, is I know that used to be really expensive. Are you able to get the assets cheap enough? And those markets I feel like have a little bit more distress than say like the apartments or, like single family that are just wild. So it's kind of creating that margin in there. And so if you're watching all these things, you can kind of change where you sit or change the amount of debt you use to take off risk. I've heard, Michael Milken and on the Milken Institute or Howard Marks or even Carl Icahn talk about your fund structure and your use of debt can protect you in up and down markets depending on how you do it. And that's something that you've talked about with me as well, is that the fund structure matters in the sense that it's how you can perform under that fund structure and how it works for your business. As long as you're not doing something outside the norm, it shouldn't matter that much. 1% acquisition fee, 1.5, depending on your pref, or like all that stuff. So,
yeah, but and I think that my take is, like, for a guy like you who's reading the tea leaves, so to speak, and really digging into the data, it sort of does break the mold, right? Because when you think about most real estate guys, they have a strategy that they execute. And so, Matt and I back in, 2011, we felt that way. Like, we had a strategy. It was basically hard money loans on commercial, owner occupied business, properties in the Pacific Northwest. And we felt that firsthand when the downturn occurred, and all of a sudden there's no equity in properties and there's no one we felt comfortable borrowing to. So we didn't like that. We didn't like that we were a one-trick pony. And of course, our solution for that was to not be a one-trick pony and to be able to have an investment vehicle that would allow us and provide us with a broad mandate to invest in what we thought, was the right thing to invest in at any given time. And, the ability, we always gave ourselves as much much of an exit strategy as we could get, meaning how can we get out of our position, even though real estate's inherently, liquid, which of course just hurt people's minds and brains, because they're like, no, you can't do that. You can't have, a hedge fund type of structure with real estate strategies. And, and of course we were like, well, yeah, we can. And we did. And it was hard. And has been hard, and it's super complicated. But Matt and I were even just talking about it last week. Like, now that COVID occurred, and now we're looking at how the portfolio is performing and coming back out of it, and we're like, it actually is a great structure. It's a ton of work, and it was hard for us to sort of figure it all out and make it work administratively and all that sort of stuff. But all that to say, it is harder, because what I hear you saying is that you are an investor first and foremost, right? Because you watch the trends, which means that, yes, you're using primarily, and you have single family residence as sort of your, the underlying asset type or property type. But what I hear you saying is that for you, you're going to act on the trend. So the ADU thing, right? That makes sense. So you're seeing the trend ahead of it, going, this is going to be problematic. The entitlement process, it's going to be an issue, or like the lumber prices or whatever. So then you see where the probability is higher that a certain thing is going to occur in the future. Therefore, your investment activity today needs to be different. But that is harder to sell to people who want you just to say. Even before we hit record, I basically said as much. I'm like, well, you need to kind of tell the people, like, what your strategy is. And of course you countered with, well, it really, in so many words, like, it depends. Yeah. It depends upon what makes sense to be doing today. That's a little harder for people to get their mind wrapped around. So how do you deal with that? Do people accuse you of, does that seem like you're flaky, or they think that you're sort of running from one thing to the next?
No, it's all in the residential space is the first thing. And, you're always controlled by your term sheet and PPM. I'm trying to move just within the real estate or the residential space to where I see the most opportunity. And this actually goes back to something that all the way back to the very first conversation I had with Bearvest. And, I read your book, Capital Attraction, and you guys are very honest, and I love your values because of how you did that. And the first thing I asked was, like, in 2008, where is there certain things that you can do to protect yourself more? And you said absolutely, and it was basically to have multiple avenues of ways to deploy capital through a downturn. And also there was the debt piece that you said that got you in trouble. And so I think really more so, and it also goes to conversations that we had, it's building trust, talking to people enough so they actually understand your strategy. Because some of the things that I say, I'm now realizing, I always think people know what I know, but some of these things are kind of a little different for the real estate market. And that's actually one of the hardest things about pitching for me is, as soon as somebody hears something that they don't understand, they're like, oh, nobody has a crystal ball, or, start that linear thought again. And so really it's building trust, having multiple conversations so they understand, what I'm doing, and that it's all within one structure. And I have to say that, like, when I first started pitching, that was a lot tougher sell until I started hearing the same type of objections over and over again. Probably the biggest one for my asset class, even though invitation homes proved the model, it's like, can you deploy enough capital into these type of assets? Because once, you and I talked about this again, and it was, modeling out something like this is tougher because the assets are small and you're kind of moving. But once they see the unit metrics on these, they're kind of blown away. And then it's, moving to the team and getting them to trust in my team, who, like one woman ran a $500 million fund and did acquisitions in 6 different markets for this type of fund, and only deployed in those small assets. And people are like, you can do that? Yeah, you can do that. Like, it's getting them to that point, I think, is how we handle it.
Yeah, and I think that is like what you're doing is, it is somewhat innovative. It doesn't, if you squint at what you're doing and how you do it, it doesn't look innovative. But because you and I, we had these discussions about whether or not, a true like open-ended vehicle would make sense, and we backed off of that, right? And I do think that the close-ended structure for what you do does make more sense. And of course, there's always you always feel like you want the investment period to be longer. So we've had that. We've talked about that a lot, right? But really, when you think about what it is that you do sort of need to create these more closed boxed, they're close-ended vehicles that really represent the vintage, which is really just a period in time. Because these, like, for example, when you've got these fractals, and obviously all the stuff you talk about is Greek to me. I'm not, it doesn't, I get it conceptually, but clearly, and I don't understand it like you understand it. I think it makes sense then, right? Because that's really the ask. The ask is just saying, okay, Mr. End User Investor, deploy some capital into this strategy, which is your strategy is, has bounds, but this is how I'm going to make investment decisions, which over the course of the investment period may change, a little bit, right? Like, meaning we might decide, we get commitments up front that we're just going to go, we're going to deploy, to your point, a lot of capital in a very short period of time. And then you may have a period of time where you're not really deploying much of any capital.
Correct.
Right. And then maybe another swing hits, and at the end of the investment period, you go nuts again and hit it hard for another period of time. But that's kind of how I interpret what more than likely would look like if I allocated capital to, equity group investors. There could be a situation where I'd make a commitment to you guys, and you might literally never call, you won't call my money in for several months because you're like, no, I don't like what I see. I can't, that could happen. Whereas many people, when they get commitments, they just go find stuff to buy just to buy. That's one of the knocks on investing in funds, because once they got the commitments, they're incentivized to go and deploy it.
Don't you think this is my whole thing is like, this is the real estate risk report. What's the risk? The person who's going to be disciplined in the way they underwrite and actually say, hey, there's something big coming in the market that turned out to be COVID. I don't want to buy. I'm going to sell off more of my assets. Or the guy who bought through it, lost cash flow for 6 months. It's getting the investors to see the difference in risk. And then, on the opposite side of the risk is your return. Like, if I go back to 2018 when we hit that one factor model, and I guess I should back up a little bit. Like, we could drill down on this if we had more time on this podcast to get you to understand like how it fits into the affordability index, or how it fits into rent versus build. You know what I mean, or rent versus buy for people and how that's distorted right now because of the Fed. You know, we could drill down more into it to get you to trust it, but also, so on the opposite side of the risk is the return. And you know, in 2018, I saw this one factor model coming, and if I had a fund, I wouldn't have been wholesaling as much. I probably would have just moved into a different asset. But at that time, I moved into what's called wholesaling, so I wasn't taking ownership on properties. I was basically just selling contracts and taking pieces. And I'm going to load all my investor emails onto the VeriVest platform just so you can see that I'm not, you know, just speaking. This was actually stuff I was telling my investors. And so what happened right after that? Multiple funds in my market got blown out. Some of them never returned, and I went on a buying spree while nobody else was buying, so I could have, you know, better prices in those assets, and my return was better. So like you might miss for a little bit, but then your return's going to be higher next, and you're kind of, you know, balancing the risk and return. And as I said, I haven't got all this stuff perfectly right. You know, I mean, I also hedge my real estate for risk. And when the Fed and Treasury merged during COVID and they started buying all types of assets, I actually lost part of my hedge because I didn't, you know, you can't predict it all. You just have to try to be a little bit more right than the rest.
Yeah, that's right.
You know?
Yeah, and I think that I think it's interesting, right? Because if as a passive investor, there's a couple things that you're dealing with. One is we all know that we should invest in things we understand, right? So, and I think that's where I'm just going to pick on the hedge fund guys because more often than not, they're using some long, short strategy, whatever, with publicly traded securities. It's a black box. Right. So it's a bigger leap of faith. And once again, you're usually going off past performance. So you're saying, well, you guys have shown that every book that I've listened to, and I try to listen to all of them on all those guys, the early days of, all those guys, because it's very fascinating. And the commonality that you hear with all of them is that they had to knock on a ton of doors, right? Because it just convincing people to give them a try was the hardest part. And then, of course, once they proved that they actually knew what they were talking about, then, you know, they had more money and they had to turn off the spigot. They wouldn't even let, you know, people in. So I think that's from a passive investor standpoint, that's the difficulty. Now, the good news, of course, is that, as we're saying, that the way that you decide whether to invest or not invest, I think is more sophisticated than most people, right? Meaning that there's a method to your madness that goes beyond just, like you said, linear thinking or whatever you want to call it, not to diminish or you know, make it sound like every other real estate investor is some dummy or something, but basically it's saying, okay, I've got a method to my madness, but ultimately, you know, it is, you know, they're single family homes. It's about, you know, whether people, you know, are going to buy or rent or build or, you know, or whatever. Underneath it, those are all things that I think we can suss out and understand, right? Like, and I think that, but really for someone like you, that's a bit, and I think this is where your intuition several years ago was like, I got to do a fund vehicle, because it's difficult if you can't manage it as a portfolio, because you're going to be making decisions on a macro level. I mean, like, you make big high level decisions. Now is the time to buy of this type specifically for whatever the reasons are. It's difficult to pull off on an asset by asset basis. You've got to do it inside of a portfolio. And that's really that leap that has to be made. And so I think for passive investors, it's understanding that, you know, there are some opportunities out there like this where the manager, the portfolio manager and the fund manager is going to be, you know, looking at it a little bit differently, right? But ultimately you do have, you know, diversification amongst that. Obviously you've got, in your case, if you end up loading up, it's going to be some geographic risk, right? I mean, just in terms of, it's most of the assets that you're going to be purchasing are going to be limited to Southern California, maybe Arizona, California in general, I guess, right? But, you know, so those are the things that it's like, if you come to me and pitch the fund, those are the things I have to figure out, right? Is like, okay, I get it. I'm going to have to make a leap of faith that your models, you know, that make sense, because there's not enough time for me to suddenly, and I think in most people's cases, enough interest, right, to actually go and learn everything that you know. And once again, that's why I'm paying you to do it. I mean, ultimately, I'm going to give you a fund management fee of some amount to manage my money. I want to be passive, right? And I want the exposure to whatever it is that you're doing. But that's the whole point of it, right? In a fund, you're abdicating your decision-making responsibility to the person that's going to manage the money. I think your point is some of these other guys just do things and no one really knows, the manager nor the investors really had a full appreciation for the fact that there was a flaw. And they'll tell you that I didn't have a crystal ball. No one does. And things happen, right? That's just life. That's sort of their excuse.
Let me maybe throw it at you this way is like, everybody knows, or it's kind of common knowledge now that, and even I saw somebody at the Fairway Conference pitch on this. There's like a NARI graph that shows that mobile home parks and self-storage goes up in a down market. Because it's the cheap. Mobile homes are the cheapest, and self-storage, people are losing their houses, so they're going to store their stuff. And so if you look at the graph, they're the only things that go up. And so prior to COVID, everybody's investing in, apartments, office, retail, whatever. And then now everybody wants mobile home parks and self-storage. And even the investors are moving from those assets to these assets. I'm doing the same thing, but I'm still bound by my term sheet and PPM of what I can buy. I'm just being a little bit more creative in how I buy, right? And I'm doing the exact same thing as the investors that would invest down into my fund, moving from a retail, maybe I don't want to pick on anybody, but maybe from like retail to mobile home or self-storage. And you see the wave going right now. There's a ton going into especially self-storage from what I see.
Oh yeah, no, there is. I mean, and I think it's because of things like you said. It's sort of, well, I heard that there's a NARI graph that shows that that's how it works. So, I mean, I guess my whole point is that I think we're all a little lazy. I mean, like intellectually, unless we have interest, we're human beings, right? Like it's just, if it's something that we're interested in, if we love history and we're history buffs, then we're gonna invest a lot of intellectual and emotional energy into it, and things like this. I mean, that's the hard part, right? And that's why I do this podcast, because my whole thing is like, stop doing that. I know that you want to do that, but it's your money, right? So at some point, are you ever going to know what Vince knows? Probably not. Do you want to? Probably not. Do I? No, I don't. Even though I host a podcast where we talk about this stuff, frankly, I got other things I want to do, right? If I that's just it. But it's like, at least make the effort to understand how these things work and dig in a little bit, knowing that, as you keep saying, like, it just will make you a little more right than you would have been otherwise. Yeah. So it's we're not going to be perfect. I mean, Warren Buffett's not a perfect investor. He invested in precision cast parts and lost a ton of money, and he thought that was a great investment, and that's what it is. I mean, your ability to generate an outsized return, that's what risk is. You need to be compensated for taking risk and understanding that it's not, you can't avoid it. I mean, unless you invest in T-bills or something, there is no such thing as a guarantee. It's just more about understanding enough, right, to generate an above average risk adjusted return, which of course is what it comes down to, who's executing the strategy and what are they doing to mitigate those risks as much as they can. But things do happen. So let's just dig in for a second. I'm curious, what your take is just on this, like the Southern California market, because that's where you do operate, right? So that is the stuff that you're looking at, and the beauty of it is, of course, it's a very, with single family, it's you've got enough product. I mean, it's as liquid as it can get. I mean, that market is highly desirable, always will be. I was just having a conversation with somebody the other day. I mean, we were talking about best places to live. As far as most of the world's concerned, San Diego, California is basically as close to heaven on earth as it gets. And the last time I checked, even despite high, property taxes and income tax and, BS, bureaucracy, people are still going to want to live in Southern California and specifically San Diego. So it does seem like for a guy like you who's very analytical, you've got enough. There's enough depth to the market where it does tell a pretty good story. Because could you execute your strategy in Wichita, Kansas, or it's
my whole thing is so. All these things like fractals and the models that I have for GDP, inflation, all that stuff, it's called institutional macro. And my whole thesis on the market is that, everybody says real estate's micro, it's local, like all that stuff. But the macro moves, like if rates move 1%, like they did in 2018, those are the moves that hurt the worst. So it could be executed somewhere else. What I'm seeing, actually across the nation, that's might change the way I do things is, we touched on it earlier, is like when the Fed compressed the OAS spreads, all that is the difference between the Treasury and the MBS market, and they kept buying more MBS than they were buying Treasury, so they compressed it 56 basis points. Now it's moved like 120, so we're starting to see the flows. You can look at like mortgage applications. You're starting to see the flows slow down on the mortgage applications, which is more of a leading indicator than these huge price appreciation we're getting. And the most interesting thing to me is when they did that. If you look at a buy versus rent right now, everybody would rather own than rent if they could. And you see the graph go all the way down, and then there's just like this one point that's like way off the graph, because when they brought down the rate so much that it's making it look like it's way cheaper to buy. And so everybody flowed in there. It created this crazy demand, created an environment where people can afford higher prices. And you can see that in different price tranches. Like, I'm paraphrasing it kind of here, but it's like, in the lowest class of assets, say in my market, like at like 500,000 or 600,000, we actually had a drop off in velocity. In the next price tranche up, we had a 20% increase. Next price tranche up, we had a 50% increase. Next price tranche up, we had a 100% increase. And now, as the rates are flowing back, we're seeing it slide back down in this rent versus buy flop a little bit. So, people, you can talk to the people that are in the apartment market, and they're saying, yeah, we're still leasing, but we're getting a lower quality tenant. And that has something to do with the eviction moratoriums and the, COVID forbearance, those things as well. I don't want to get too deep, but basically they're still able to lease, but the assets are, not as many people want to go in there because of the issues. And my whole thing is, whenever big shakeups in the market happen, everybody's looking for the opportunity all at the same time and trying to figure it out. And I think as the eviction moratoriums roll off and you can start getting price increases again, the rates go up and there's going to be like a higher quality tenant, the rental is going to outperform the purchase market for a little while. But it's like I was saying earlier, it's not going to be an on-off because the inventory is so low. As the rates go up, it's just going to crank the market, down slowly, and then maybe all at once a little later. We'll see how the risk plays out over time. So I think for me right now, I'd rather go into the rent than the purchase. But as you asked before, you could do this on any market because it's a macro overlay.
Yeah, and so and what you would apply is just that's where it comes in. It's just more of you take the macro, you overlay it, and then you say, I take my local knowledge. Those are the things that, are helpful. Like that house there, I know that market, I know that neighborhood. Your ability then, and not to mention just to be in deal flow, right? Because you're aware of what's going on and what you can buy. If you were sitting on 20 million in commitments today, what would you do?
I'd be changing use small apartments. As I said at the very beginning, I don't want to go into the institutional where all the, it's two different problems or whatever. If you're going to go build 200 units, there's billions in institutional capital all chasing that type of deal. And so it's then, can you have a different strategy to get the return? With mine, it's the return is crazy. It's, can you get enough assets to do that? And I think right now with the some of the change of use stuff, or taking mixed use and turning it into all residential, so it still fits within my PPM and term sheet. That is where like you're going to find, or I'm seeing the highest cap rates over market. So that's what I would do for now, and then I might start changing space with ADUs as well, because there's some pretty good metrics on cap rates there, and it'd be more rent than the flip stuff. The flip stuff right now, like in my market, it's always like 80-90% is some person that saw a home flipping show and thinks it's easy, and then they jump in and lose 50,000, and then they're like, oh, that's not so easy, especially in the market right now where people are competing on assets and buying way over. So you need to be more disciplined there, and you can be more, go after more assets in the rental is what I'm seeing currently.
Yeah.
And right. If you think back to like 2008 too, we had the same exact thing. Right after 2008, people didn't want to buy houses, or they losing houses, and they all flowed back into rental. You saw a little bit less of a value on the apartments, but the cash flow actually went up because there's so much demand for rental. And we're seeing that with that buy versus rent right now, and it being so like it looks weird how low it is. There's just like one dot down there, like it's out of the norm, Yeah.
Right. Yeah, no, it's fascinating stuff, and it's certainly it's in many ways it's just very unprecedented. Obviously, just the things that they're doing we haven't seen before. Once again, when they do them, like all the stimulus or whatever, to your point, it impacts what the data then says and people's behavior, and that's macro level stuff. So if you're paying attention to it, you can be keep using your language. You can be more right than the next guy, right? You can increase your odds of making good investment decisions, and I think that's the important thing, right? Is that if like I said, if you're an armchair guy and you don't want to learn everything that Vince knows, that's fine, right? But understand that he who has data and understands it, it's powerful, and making decisions that aren't entirely emotional, right, but are based on sort of data and analytics. The stuff works. It's just that in real estate, the conversation you and I just had, it's just not a part of it, right? Like there's just not many people who are thinking like this or even attempting to, right? Because if they're being honest, and I know this because how many guests have I had on the show, and I try having conversations like this, and I realize, and it's not to say that they're not good at what they do, right? But you realize that the method to their madness is usually, one, I'd say it's very much operational, right? So they are focused on controlling the things that they can control specifically. But most of these decisions, let's just be real, they're not really being made on with much analytical rigor. That they're being made on sort of just seems like the right thing to do. And because these waves don't move that fast, which once again, there's not the volatility, all things being equal, this versus the stock market or something is night and day. And so, but I think that's just it. That's the beauty of real estate, is that you can be super analytical and really increase your odds of doing the right thing at the right time in anticipation of things that will move in the future. But all in all, I think that it is like real estate's generally safe as long as you are prudent, and the people that scare me more than anyone, I'm sure it's the same with you, right? Is the guys who move really fast and buy everything that they see. That's the most dangerous type, It's just they put offers on everything, they buy everything, and they just ride the wave until they crash.
Yeah, and
That's
it's something
terrifying.
that I guess I could leave with. A lot of this stuff it's even more complex today. And if I go back to Annie Duke, she was a poker player. She advises like a lot of these hedge funds and large investors on making better decisions within the market. And she said, if you look at history, already your decision making process will be better just by looking at history. And a lot of things of what you just said, like everybody just thinking, I'm just going to buy like value add assets and I'm good and not look too much to the analytics is, since 1980, what did we do? When we went into a downturn, we dropped the rate 5%. We went 2 standard deviations down to get a huge price increases. Next cycle, all the way till we hit 2008. We couldn't drop it anymore. And then we had to go through experimental policies. So this stuff became more complex in 2008 when we started doing QE. Now they can't even do QE anymore, so they had to change it again, and the Fed and Treasury had to merge to go buy junk bonds, investment grade, which are all acting slightly different. They're now buying MBS, which really distorted our market in a lot of ways, and so everybody's looking at it like, what's going on? This isn't acting like it normally does, but they've also been trained to think a certain way, and even them buying the MBS just furthered that. That's why they're like, oh, we're not going to have a downturn for 3 years or whatever now that it's so crazy, but it's been trained that way to not go out and search these things. But look at history. This is the last thing I guess I'd say.
Yeah, no, it's great. It's good stuff. I always enjoy our conversations. So Vince, where can people learn more about you and find you and nerd out on macro trends and data and fractals?
Obviously, VeriVest, the sponsor interview. I don't do much social media. You can find me on LinkedIn though, and then equitygroupinvestors.com is my website as well. And then
Yeah, it's good stuff. Yeah, so Equity Group Investors they are a VeriVest sponsor network member, so we're happy to have them. And you can go to equitygroupinvestors.com to learn more and connect with Vince. All right, man, it's great catching up. Take care. Yep.